The financial market is often described as the pinnacle of human rationality. Millions of decisions based on data, state-of-the-art algorithms, and the relentless pursuit of efficiency. But sometimes, this facade of order crumbles in a matter of seconds. On May 6, 2010, the Dow Jones Index plummeted nearly 1,000 points in less than half an hour. Billions of dollars in market value simply evaporated, and just as quickly as they vanished, they returned. What happens when liquidity disappears and the price on your screen becomes a mirage? Today, we're going to analyze the anatomy of a rapid collapse, exploring how technology and the biology of fear merge to paralyze the global financial system. To understand a crash, we first need to demystify liquidity. Many investors believe that liquidity is a constant, like gravity. In reality, it's a service provided by agents who are willing to buy or sell at any given moment. In the modern market, these agents are mostly algorithms. When a stress event occurs, like the 2010 flash crash, liquidity doesn't just decrease, it evaporates. Market makers shut down their systems to avoid catastrophic losses. The result is what we call a liquidity vacuum. With no buy orders in the way, any sale, no matter how small, causes the price to plummet to the next available level. This is how shares of solid companies ended up trading for just a penny during the chaos. Have you ever witnessed a vacuum moment in an asset you follow? Share your experience in the comments so we can discuss the microstructure of these events. If the order book is the battlefield, then high-frequency trading algorithms, or HFTs, are the armies. They operate in milliseconds, a timescale the human brain can't even process. The problem arises with what we call latency, arbitrage, and mass cancellations. In moments of crisis, HFTs can cancel thousands of orders in less than 50 milliseconds. This creates a cascade effect. An aggressive selling algorithm consumes the available liquidity, which in turn triggers the automatic stop-loss orders of other investors. These orders, in turn, push the price even further down, creating a feedback loop that the human mind cannot manually interrupt. But we can't just blame the machines. Behind every algorithm, there's a human directive, and behind every panic sale, there's a biological response. Neuroeconomics teaches us that the brain processes risk and ambiguity in distinct ways. Risk is something we can calculate. Ambiguity, on the other hand, is the total uncertainty about the future. During a crash, the brain enters survival mode. The amygdala, responsible for our fight-or-flight responses, takes over, hijacking the prefrontal cortex, which is our logical center. The result is herd behavior. You sell not because the company's fundamentals have changed, but because everyone else is selling. To put this in context, let's compare how the speed of collapses has evolved over the decades. Let's start with Black Monday in 1987. The trigger was a strategy called portfolio insurance, which automatically sold futures as the market fell. The entire crash unfolded over several hours. At the time, there were no real automated defense mechanisms. Now, fast forward to the 2010 flash crash. The trigger was a large, aggressive sell order from an HFT algorithm. The drop took mere minutes. The main defense mechanism, the circuit breaker, was still largely a manual process and not fully equipped for this new speed. Finally, let us look at the market drop during the early days of the pandemic in 2020. The trigger was global uncertainty. The decline happened over weeks, not minutes, but it was incredibly volatile. By then, circuit breakers were far more effective. These automatic pauses in trading were triggered multiple times, forcing the market to stop. They act as a pedagogical break, reducing the cognitive load on investors and allowing rationality to return to the system. The financial market will always have moments of irrationality because it's a reflection of our own biology. The lesson for both the investor and the economist is clear. In an age of high-frequency trading, patience is a competitive advantage. To protect yourself, avoid market orders during times of high volatility. Instead, prefer limit orders, which guarantee your execution price. And remember, when the stock market halts, it isn't breaking, it's just taking a breath, so that you can take one too. If this technical breakdown was useful for your market perspective, subscribe to the channel and share it with other professionals looking to understand the mechanics behind the numbers. Until the next analysis.